What I am about to show you today is going to fundamentally change the way you look at the silver market. Not because I am going to give you my opinion, not because I am going to speculate about what might happen someday, but because two of the world's largest primary silver producers just filed their quarterly earnings reports. And buried inside those numbers is the single most explosive piece of evidence that the COMEX silver price is no longer the real price of silver. And once you see this, you cannot unsee it. Before we get into this, hey, James here. This is Noble Metals. I need you to do something. Drop a comment right now and tell me where you are watching from. Are you in the United States, Canada, Australia, the UK, somewhere in Europe? Drop your country in the comments because I want to know how far this message is reaching. The narrative that the COMEX futures price is the real price of silver. That narrative just died, and two mining companies just signed the death certificate with their own audited financial numbers. Now, let me take you through exactly what happened, what it means, and why it changes everything going forward. Hecla Mining just reported their fourth quarter 2025 results. Hecla is not some junior explorer operating out of a trailer in Nevada. This is one of the oldest and most established silver mining companies in the United States. They have been producing precious metals for over a century. They are publicly traded. Their numbers are audited. Their financial statements are filed with the SEC. These are not rumors. These are not estimates. These are hard, verified, legally binding numbers. And here's what those numbers say. In the fourth quarter of 2025, October through December, Hecla Mining reported an average realized silver price of $69.28 per ounce. That is the actual price they received when they sold their silver during those 3 months. Not the price they hoped for, not the price they wish they got, the price they actually received from real buyers, paying real money for real physical silver. Now here is where it gets interesting. During that same quarter, the average silver price, according to COMEX, the official benchmark used across the financial world, was approximately $54.83 per ounce. That is what the screen showed. That is what every financial website, trading platform, and news outlet quoted as the value of silver. But Hecla was not selling at $54.83. Hecla was selling at $69.28. That is a difference of over $14 per ounce, roughly a 26% premium above the so-called official price. Stop and think about that. If the government assessed your house at $400,000, but a buyer standing in your living room offered $540,000 in cash, which number is the real price? The cash offer is the real price. The assessment is just a reference. That is what is happening in silver. COMEX is the assessment. The miners' realized prices are the cash offers, and the cash offers are 26% higher. But this becomes explosive because Hecla is not alone. First Majestic Silver also reported its Q4 2025 results, and it is another major primary silver producer with independent management and customers. First Majestic reported an average realized silver price of $69.74 per ounce, almost identical to Hecla. And unlike Hecla, First Majestic explicitly compared its realized price to the average COMEX price for the quarter, highlighting a premium of about $14.50 per ounce. Again, roughly 26%. Two different companies, two different sales teams, two independent operations. Same result. 26% above COMEX. What are the odds both companies perfectly timed the market for 3 straight months? Essentially zero. This is not trading genius. It is structural. What happened is that physical silver buyers companies that actually need the metal are paying prices disconnected from the paper futures market. They are not buying on COMEX. They are negotiating directly with miners through bilateral agreements that reflect real supply and demand. And that reality says silver is worth about 26% more than the exchange screen price. To understand why, you need to understand COMEX mechanics. COMEX trades, futures, contracts, promises to deliver silver later. Most contracts are settled in cash, rolled over, or closed before delivery. For decades, this system functioned because arbitrage kept paper and physical prices aligned. If prices diverged, traders would exploit the gap. But that connection now appears broken. When miners consistently sell at $69, while the exchange quotes $54, that gap reflects two different markets. One trades promises, The other trades metal, and the market trading metal is pricing silver higher. The buyers going direct to miners are industrial consumers, solar manufacturers, EV producers, semiconductor fabricators, medical device companies, AI hardware builders. They need atoms of silver, not contract. These companies cannot operate factories using futures positions. They require guaranteed supply. If the exchange cannot reliably deliver, they bypass it. They call miners directly and negotiate long-term supply agreements. They lock in ounces at higher prices to ensure continuity. That is why miners are receiving $69 to $70 per ounce. Industrial buyers understand that securing supply is more important than chasing a paper benchmark. This migration of price discovery does not happen with headline. It happens gradually, then suddenly, through audited financial statements showing persistent premiums. Look at what is happening globally. The Perth Mint in Australia has struggled to keep up with demand and implemented allocation systems. The US Mint has repeatedly suspended certain silver coin sales due to demand pressures. Dealers in India have faced delivery issues. Costco has placed purchase limits on silver bullion. These signals all point to tightening physical supply. Meanwhile, COMEX trades digital contracts that can be created instantly. The physical market shows deficit conditions. The paper market prints a lower number. Skeptics argue miners time sales well. That is statistically implausible across two major producers for an entire quarter. Others say premiums over spot are normal. Small fabrication premiums of 2-5% are normal. 26% is not. Some argue COMEX still has inventory. True, but registered inventory has declined. Eligible inventory is not the same as deliverable inventory, and paper claims far exceed physical metal. There is a difference between functioning and not yet collapsed. From a miner's perspective, if direct buyers pay $69 while COMEX quotes $54, supply shifts toward the higher bidder. Less metal flows into exchange warehouses. That reduces physical backing for futures contracts and widens the gap further. It becomes a self-reinforcing cycle. As the gap widens, more buyers go direct. As more go direct, exchange credibility weakens. This is logical economic behavior, not speculation. Other miners are likely examining these numbers and reconsidering distribution channel. Global silver demand recently exceeded 1.2 billion ounces, while mine supply was roughly 820 million ounces, a deficit of about 380 million ounces. This deficit has persisted for 5 consecutive years. The shortfall has been covered by inventories, ETF liquidations, and recycling. But those sources are finite. As inventories decline, physical buyers increasingly secure supply directly from producers. That is consistent with the premiums reported by Hecla and First Majestic. For investors, implications vary. Physical silver holders own the asset. Industrial buyers are paying roughly 26% above spot to secure. Buyers of physical metal pay premiums over spot, but those premiums may reflect real market pricing more accurately than exchange quotes. Paper traders in futures, options, or leveraged ETFs face margin risk and volatility tied to the exchange mechanism. A margin call can liquidate positions regardless of long-term fundamentals. Looking ahead, watch additional miners' earnings reports. If Pan American Silver, Mag Silver, Silvercrest Metals, and others report similar realized premiums, the pattern strengthens. Monitor Shanghai Futures Exchange inventories, COMEX registered stocks, lease rates for physical silver, and retail premium. Rising lease rates and shrinking inventories would indicate tightening conditions. Consistent 20-30% realized premiums would confirm structural divergence between paper and physical markets. If this two-tier structure accelerates, either the COMEX price rises to meet the physical market, or its relevance as a price discovery mechanism declines. Mine supply cannot expand quickly. New production takes years to develop. Meanwhile, demand from solar, EVs, AI, military, and medical sectors continues growing. This analysis is based on publicly filed, audited financial data. 2 producers, 2 independent reports, similar premiums. The implication is clear. A widening gap exists between exchange pricing and realized physical transactions. Investors must decide how to position themselves within that evolving market structure. I'm not here to build a cult of followers. I'm here to build a community of thinkers. At Noble Metals, I provide the raw data, but I want you to bring the hard questions. We live in an era where debt is sold as wealth and clicks are sold as value. Don't just take my word for it. I encourage you to be a skeptic. Check my sources, challenge the mainstream narrative, and verify every claim I make, because at the end of the day, a truth you've discovered for yourself is far more valuable than any hype or financial trend. Real gold is rare, but real truth is rare. Let's find it together. This is Noble Metals. I'll see you in the next one. Stay skeptical.